Anyone who's ever put money into something knows that one big question that's always in the back of your mind: when do I get my money back? So today, we're going to break down this simple calculation that gives you that exact answer: the payback period. All right, let's just dive right in. Look, it doesn't matter if you're investing in a startup, in real estate, or even just a new coffee machine for your business. Every single investor starts with this exact same question. And that question is so simple, right? When do I get my initial capital back? It's the most basic question of all, but you would be absolutely surprised how many investors can't really give you a solid, precise answer. You know that feeling, right? That little bit of anxiety while you wait for your capital to come back? It really can feel like a race against time. But what if I told you there's a simple way to get a clear answer? Well, that's exactly what the payback period is designed for. So, what exactly is the payback period? Let's break it down. In simple terms, the payback period is just the amount of time it takes for an investment to generate enough cash to pay back its initial cost. It's that magic moment where you can finally breathe and say, okay, I'm back to zero. Everything from here on out is profit. Think of it like a quick and dirty tool to see how risky an investment is. It tells you exactly when you've gotten your initial cash back, and more importantly, it pinpoints that break-even point where the real profits actually start rolling in. And you know what the best part is? You don't have to be some kind of Wall Street wizard to figure this out. The math is super, super simple. So here's the magic formula. Your payback period is just your total investment divided by your annual net cash flow. That's it. Now let's actually plug in some numbers so you can see how it works. Okay, first up, you've got to know how much you put in, your total investment. So for this example, let's just say you dropped a cool $1.2 million on a new project. All right, next piece of the puzzle, the annual net cash flow. Basically, that's the money the project brings in each year after all the expenses are paid. And let's say our project is bringing in a steady $300,000 every single year. So you just take that $1.2 million you invested, and you divide it by the $300,000 it's making each year. And boom, what do you get? 4 years. That's it. That is your payback period. It's going to take 4 years to get your initial money back. So we know how to do the math. But why is this little number so important? Why do investors care so much about it? Well, the benefits are actually pretty huge. The basic rule is the shorter the payback, the safer the investment. It's really that simple. It also gives you a totally objective way to compare different projects side by side. You get a clear idea of your future cash situation, and because you get your money back faster, you're not as exposed to crazy market swings down the line. And this is the real kicker, right? When you get your money back faster, it's not just sitting there locked up in one project. It's free. You can take that cash and jump on the next big opportunity. That's how you really start to build wealth. And this simplicity? This is exactly why small business owners absolutely love this metric. It's easy to get, you don't need any fancy software, and it's a super fast way to just say no to projects that are going to lock up your cash for way too long. Okay, but here's where we need to be careful, and this is a really big but. The payback period is great, but it is not a perfect tool. It's super important to understand what it doesn't tell you. So here's the deal. This calculation has some massive blind spots. For one, it totally ignores any and all profits that come in after you've been paid back. And maybe even more importantly, it doesn't consider the time value of money. That simple fact that $1 in your hand today is worth way more than $1 you're promised 5 years from now. You know, if you only use this metric, it's kind of like driving a car at night, but only looking at the 10 feet right in front of your bumper. Yeah, you can see what's right there, but you have no idea what's coming up down the road. And that can be a very, very expensive mistake to make. And this is where it gets really dangerous. You could end up picking a project that pays you back in, say, 2 years, which sounds great, but then it completely dies. And you might have passed up a different project that would have taken 5 years to pay back, but would have kept generating huge, stable profits for the next 20. The payback period doesn't tell you anything about that. So, what's the takeaway here? How do we use this powerful but kind of limited tool the right way? The key is simple. Don't use it in a vacuum. Make it one part of a much bigger, smarter decision-making process. Here's a little 4-step checklist you can use every single time. Step 1, figure out your total investment. And I mean everything. Be totally honest with yourself. Step 2, estimate your cash flow. And be realistic, not just hopeful. Step 3, do the easy math we just talked about. And then, step 4, and this is the big one, step back and evaluate. Ask yourself, is this time frame something I'm actually comfortable with? At the end of the day, the payback period is an amazing, simple tool. It's fantastic for quickly measuring risk and how fast you'll get your cash back. But remember, it's just one tool. You wouldn't build a house with only a hammer, right? The goal always is to invest with your head, not just your gut. Use the numbers, understand what they're not telling you, and make a smart decision for your whole financial future.